Hello and welcome back to the Note, still coming to you from Arizona. Now, the big story for the day continues to be oil and resources, a continuing aggressive sell-off there. We even saw Brent briefly drop below $40 a barrel today. Part of that, as you can see, is that oil is still in a very severe downtrend following last week's OPEC announcement. Another big new element of news today, however, particularly for other commodities, was the latest information on Chinese imports. Very alarming how those imports continue to fall. You can see that now if you go on a 12-month moving average, as you should, because they're very seasonal, the outright fall is actually greater in the amount that China is buying from the rest of the world. The outright fall is actually greater than it was during the Great Recession of 2008-2009. Now, oil creates great interest for the ETF community that I've been covering at this conference, because there is also, as we know, in Paris, a conference going on low carbon. There is great interest in a new family of indexes. Goldman Sachs has produced one for the New York State pension fund last week along these lines, which aim to give you the index but reduce the carbon footprint. They use some very clever optimization processes to do that. If you take a look at how an MSCI index, which reduces its carbon footprint but aims to match the MSCI All World Index, has done, you can see that the financial engineering behind this has worked really superbly well so far. It's great interest in the attempts to use indexing to deal with low carbon pressures in the economy. Are there any questions about that, however? Well, there are a few. One is, could it really have been this easy to perform well if oil companies, if big carbon producers had actually been performing well, which obviously, particularly for the last 18 months, they really haven't. Also, a lot of the data that we're relying on when producing these indexes is self-reported, so there has to be some question as to whether this could really continue in the style that it has done so far. But there is great interest, plainly, from many pension funds in trying to do something about reducing exposure to oil companies, even if with the oil price where it is now, there's got to be a chance of a rebound, and B, given the pressure coming to improve the environment to combat climate change from efforts such as Paris, B, there is a great interest in reducing carbon footprints anyway. This is certainly not an issue that is going to go away. It's going to be a very dominant debate within the investment community.